Good afternoon, everyone, and welcome to the first ever Rask Invest portfolio update. My name's Mitchell Sned, and I'm joined today by our analyst, Kevin Fung, and of course, Owen Rask, live from Florence. You might be able to hear the bells in the background there.
Yeah, I just unmuted myself. Sorry, Mitch.
Today we'll be going through the portfolio holdings. Of course, 1 month is not an investment make, but we'll be going through each portfolio, what's taken place in them, but also going across the research that Kevin's been doing, and Owen as well will give us a bit of an outlook and answer a few of your questions. So before we get going, Owen, I'll hand over to you for, of course, the most important part of our session.
Yeah, sure. And good afternoon, everyone. Or it's morning for me, but good afternoon, everyone back in Australia. We've got the disclaimer to get through, so I'll just bring this up on the screen now. It'll take me just a second. We do have a really interesting chat for you today, so I'm just going to get my slide in place and not share all of the secret sauce. Just kidding. There's not much. Here we go. Sorry, guys. Here, and here we go. So the bit that everyone loves is the disclaimer. So this disclaimer, obviously, and the one I'm about to read out is really important for us at Rask. If we do answer your questions on the show today, or if you do watch this back and you have had one of your questions answered, please note that we do generalize everything. And that's because we can only answer questions in a general financial advice manner. Nothing that you hear today is specific to your needs, goals, or objectives. And one of the extra disclaimers that we'll also include every time we do one of these webinars or monthly updates is a link to our target market determination. That's the TMD. You can see that just down the bottom here, pardon me. This is basically the document that lays out what the investment strategies are and who they may be suitable for. The other one that we will always reference is the PDS, or product disclosure statement. This includes all the fees, who the partner is that we have in InvestSmart, how we operate, a bit about us, a bit about them, and all the nitty-gritty that you'd probably want to know. Because Rask Invest is quite unique, it's a really good document to read through. So Mitch, that's the disclaimer done, mate, and I'm happy to be directed by you on the slides if you need be.
Yeah, fantastic. Excellent. So we might just start off going through just about a few of the key themes that keep coming up with the clients that I've been speaking to over the last few days. And I will put a link to my Calendly booking in the chat. So if anyone wants to reach out and have a conversation with me, they can. It does fill up pretty quick. So I'll do get in if you want to have a conversation. So a couple of things that have stood out to me over the last month is all of the investors that are coming to us are really switched on. You know, they're smart. They've been following the podcast for a long time. They've been reading the research for a long time. And I say to them that in my mind, there's absolutely no doubt to me that they could manage a portfolio of, say, ETFs themselves. But a deciding factor for a lot of them has actually been the time and the opportunity cost that comes with that time. So they could put in the research to handpick the ETFs. They could put in the research to weight those ETFs appropriately and then monitor for rebalancing opportunities. But at what cost to them? So they are weighing up against opportunity cost in their own life. And that can be from their own career. So doing courses to further their own education, or also just spending more time with work or spending more time with their family. And so they've been weighing up that cost against, say, the cost of a managed portfolio and the management fee of that. And they're often finding that the management fee is insignificant up against that addition, that cost of their own time. So that's a conversation I've been having with a lot of people. As well, for them to actually dive into further the research that they enjoy the most, which is the satellite components, generally speaking, like people who love to get in the nitty-gritty of companies. And we're going to be talking a few satellite positions with Kevin. So I find that's a very, very common conversation that's been happening. Something that we'll jump into as well when we maybe hit the questions kind of side of things, Owen, is the dollar cost averaging versus lump sum investing. So I've got people approaching Rask Invest with a lump sum of cash at the moment, and they're unsure if they should set up a dollar cost averaging strategy where they might do start off at the minimum investment of $20,000 and then just gradually add every single month, or if they should just go bang straight in. So it'd be awesome to hear your thoughts on that. I've been doing a fair bit of reading myself, and I've got a view on it. And then getting there, a lot of people, especially now, and it's going to be happening in the next couple of weeks as well, getting their ducks in a row for a clean start in 1 July. There's a lot of people out there who've been following Rask for a few years. They've got an overlap in the ETFs that we hold in the portfolios. They're wanting to get going with Rask Invest by transferring in those ETFs. And so they're getting the ducks all in a line, having the account open. We're getting the in-specie transfer paperwork sorted out. So they're ready to submit that early in the new financial year. So if that's you out there looking to do that, give me a shout, get in touch, because an in-specie transfer, there's a little bit of work involved. Not too much, so don't be scared off by that, but just a little bit. And so it's great to get on top of it now before the financial year starts. So that's a bit of just a quick whip around about what the conversations I've been having with people. Owen, should we jump into the your actual presentation on the portfolios?
Yeah, sure, Mitch, and thanks for that. It's always interesting, like a lot of, it's really interesting perhaps just for Kevin and I to hear from you, because a lot of the times we're researching and you get to speak to most of the investors in the community one-on-one, which is a really cherished spot to be in. But yeah, I can see that Jim's commented in the chat. He said hi from Greece. Jim, your YouTube handle also says Jim Greek, so I don't know if that's where you reside permanently, but let us know in the chat. And Katie and Jenny, good to see you again. Yeah, so I think if you go to the Rask websites, and I'll bring this up, the Rask Invest website is probably the best proxy. I'm going to switch between both Navexa, and I'll switch between the Rask Invest website when I talk about performance and these types of things. Obviously, a disclaimer that I didn't insert before is that past performance is not always indicative of future performance. It's a really important thing to understand, particularly when you look at ETFs, more so when you look at active fund managers, and even individual stocks and these types of things, which most of us know by now, but just in case you're confused, I would almost never look at the 1 year track record of a fund manager. Index funds and ETFs are a little bit different in that they track an index, which is pretty, straightforward. You don't need to worry too much. Like if the fund has only been around, or the ETF has only been around for 6 months or a year, it's not as risky to me as, say, an active fund manager who's only been around for 1 or 2 years, simply because the processes that they follow are typically quite straightforward versus an active fund. But on the Rask Invest website, you can log into your dashboard, you can see performance. This is updated end of day. But if you follow us, if you're a Rask Core member, you can also set up the portfolios in Navexa or ShareSite, it doesn't really matter. And if you have a certain account with Navexa, you can actually set up the 3 different strategies, and you can just toggle between them like this. And you can see performance over time. You can see attribution, or what we would call attribution in finance, which is like what attributed to the gain that month or what attributed to the decline. You can see income and that sort of thing as well. So even if you're not invested with us, if you do it yourself, you can set up Navexa properly, and you can have that all handled on your end. Obviously, we do all of the tracking ourselves. But if we go to the public version of the website, there's one extra thing I want to call out. So if you click on anyone, you don't need to be logged in, you don't need to have an account with us, anyone can see this. If you look down the right-hand side at the top of the page, there's the performance. And we've got since inception and 1 month here, and soon that will have 3 months and 6 months or 12, a year, 3 years, etc. once it slowly builds out. But one of the things to keep in mind here is basically the since inception numbers are since March 2024, and these are updated once a month. So obviously when we do a monthly report like today, for example, they were updated yesterday. Normally it'd be a little bit earlier in the month, but because of the way the weekends and the long weekend fell, it was a little bit different this time around. So just to really nail home, if you're invested with us, go straight to your account, your dashboard. And if you're not invested with us, you can look at this once a month, and that will give you an accurate reading of performance. Now, what actually has contributed to declines since inception and versus the gain month over month? It's pretty straightforward. So all of the portfolios rose during the month of May between 0.3% and 0.42, I think it was, 0.41. And the reason is that during this month, there was no major economic news other than maybe inflation coming in higher than expectations. But in the first month of our launch, you may remember that basically economists and all these people all of a sudden were interesting again because we thought as a country, well, maybe interest rates won't drop this year. And it basically switched from expecting at least one interest rate cut to most of the professional side of investing expecting that there won't be any interest rate cuts this year. And some, such as economists at ING Bank, that is, thinking that maybe we could actually have an interest rate increase in 2024. And one of the things I think that's really important to take away when you read these types of headlines is not so much what's going to happen 1 month, 1 quarter, etc. Because we're invested with a multi-decade approach, is to think, what's the historical average? What's reasonable in the context of what we're seeing in the economy? And for all intents and purposes, the economy is growing really well, but there's obvious pockets of weakness. So it has been my opinion, and I think the stance is what I took to the investment committee with Kevin, is that we think interest rates are at a point where they're quite reasonable to contain the economy. And I think the RBA said not too long ago that they're not going to over-engineer interest rates, meaning that they won't keep people guessing, like mortgagees and people that own homes like myself that have a mortgage. They won't keep us all guessing it. Oh, it's going to go up 0.25% this month, or it's down 0.25 next month, because we know that it takes quite a bit of time for interest rates to trickle through an economy. But basically, that's what happened. Is in the first month we saw that the expectations around interest rates changed, and this month it was much more stable. The way, just one final thing here before I get into specifics in the portfolio, is that it's really important to understand that when you invest through ETFs and when you invest through even active funds as opposed to individual stocks, they tend to be a bit slower moving in terms of like what actually contributes to rising and falling prices. Whereas, say, an individual stock will react really powerfully in 1 or 2 days to really important news. But as you zoom out of your portfolio and you build and you put the proper building blocks in place, you don't actually have to stay up at night and worry about what's happening, because the fundamental drivers of the performance over the long term don't change nearly as quickly. And the variables aren't, if we invest in a company, let's say we invest in a company like Xero, which is an accounting software provider, we know that if MYOB comes out with a superior product, or if QuickBooks, fails at delivering one of its products, we know that will have a very significant impact on the share price. But for an ETF, we simply don't see that because that's not the way they work. If I drop into specifics this month, one of the poorer performers over the month, and you'll see that if you're inside Navexa or something like this, was the FMEX managed fund, which is soon going to be called the FMEX active ETF. This is really the only ETF or fund, I should say, the only position maybe in our portfolios that had any type of news, which I should report to you. And that is the wonder of investing the way that we do, is that we don't stay up at night either, worrying about individual positions beyond what is necessary. If you've ever wondered why most people in finance are bald or going bald, in the case of me, it's because we spent too long trying to manage people's money and trying to manage their expectations, investing in individual companies. But
since you've found passive investing, Owen, have you noticed that it's actually started to fill out a bit more? Or?
Oh yeah, absolutely. So for me personally, like I've found that I just find myself less stressed. Like I'm here in Europe right now, very fortunate to be in Florence. So I apologize for any background noise, but I still have some shares and these such things, and I still will actively invest in individual shares, but I worry far more about other things than what we are invested in overnight. Obviously, this one thing actually, Mitch, is the type of thing I do lose a bit of sleep over, and maybe some hair over time. I'm going to show you something I actually don't have it here in front of me. I'll see if I can get it up. Here we go. That's the one. So I'm on the market index website. But if you noticed, if you were following along with any of our positions, you may have seen something like this come up in your, I guess, notifications or however you get it. And you would have seen a temporary pause in trading for the FMEX active fund, managed fund. It's soon going to be called, if it's not already, it's soon going to be called an active ETF. And there's an important reason why. I'll just make sure I've got the right document so you can actually see what it said. So here you can see it says that responsible entity confirms that there was a technical issue that has been resolved. So basically everyone, and I'll switch away from the screen for a second. So everyone on the call would know the way an ETF works is that you invest in the ETF, and when you invest your money, typically when you place your trade, you're not trading with another investor. Typically you're trading with an institutional investment company, and that company is solely responsible for taking your money, giving you units, and then going and buying all of the shares inside of that ETF. Now, what can happen in this instance is this is called a market maker situation. And this is where it gets really interesting, because this is the one thing that keeps me up at night, is because if there is a breakdown in the market maker and the functionality around the market making, that's when you can have a pause in your ETF and you can't trade it. And typically this is just temporary, like they come back online and everything's fine. And as long as you're not in a rush to buy or sell during this time, there will be no impact. So you won't even know it happened. You probably didn't even notice this happened. And the reality is that when this transpires, what's happening is the market maker cannot secure all of the basket of shares. With the FMEX ETF, what happened this month, or what happened last month, was the company made a decision to move from an internal market making function where they fulfill that own obligation. So Fidelity itself actually does that, to allowing third parties to do it for them. Now, that's really important, and it's a much better way to operate, because typically in the past, a lot of active fund managers, they never wanted to give up their secret sauce. So they wouldn't allow the market maker, in this case, the one that's fulfilling your order, to know what they have to go and buy and sell, because they didn't want everyone to know what was in the portfolio. And thanks to a few more technical changes, basically now the fund managers don't have to reveal their entire portfolio to the market maker in order for the market maker to go and buy the shares and deliver them to Fidelity. And so this has been a pretty significant change. And Fidelity announced this, I think it was 2 months ago, and it came into effect. And that's why there was this thing that happened. And basically, this is the best way to operate, because in the past, the fund managers used to be able to do things that may be to their benefit when they were fulfilling their obligation to you. So this is actually a really good move, and this is why it will be able to be called an active ETF. There's absolutely no change to the position, and there's no change to our holding in it. It's just something that you should all be aware of. And it's actually a good move, and it won't happen again, because once you go to external market making, you basically never go back. Now, hopefully that didn't get into the too much technical specifics. It's just the one thing that has come up throughout all of the research so far. And other than that, Mitch, I'm happy to talk about some positions if you want me to.
Yeah, absolutely. So, Owen, what has come up in conversations that I've been having? I think two to three core conversations have been. We've got IVV, which is the iShares S&P 500 ETF, and I know we have touched on this in other webinars, but I think it's good to clear it up here on a portfolio specific webinar. Where IVV, we hold that's the S&P 500 ETF. We also hold IHVV, which is the hedge version. So by having the hedge version in the portfolios, and it is at a lesser weight than IVV, I will note. Is this an actual call on the currency by you Owen and Kevin? Are you guys do you have an outlook on the currency movement? And why have you got the hedged version in there when we all know that hedging costs a little bit extra as well?
Yeah, so I think y'all can see the screen in front of me here. This is something that we've shared before. It's available if you just Google Rask currency hedging or Australian dollar, it will come up. this is more of like a technical analysis show. If I put all these squiggly lines all over the screen and call it science, but the reality is that you can see the dark shaded area. That's the actual level of the currency, the Australian dollar, and then you can see these green lines, which are called Bollinger Bands. But really, it's 2 standard deviations for any of the mathematics wizards in the room. That's just 2 standard deviations either side of the currency. And then this orange line is the long run average. So this would be like 5-year average. And what you can see is the Australian dollar is significantly below its 5-year average. But if we go back over the long term, it's actually probably closer to its natural average, as in for the very long term, since it was floating. Obviously, depending on the way a currency goes, it can have an impact on the returns you achieve as an individual investor. So what most financial advisors have done historically is they would literally just cut their position in 2. They would say, well, if there's an S&P 500 unhedged, meaning it's just US dollars, we'll buy half of that. And then if there's an S&P 500 hedge, we'll buy half of that. And fortunately for individual investors now, thanks to ETFs, there's an ability that we can all invest in a similar way and incur negligible costs. So the S&P 500 ETF from iShares, IVV, is 4 basis points in fees, 0.04. Like you wouldn't even know. And then the hedge version, IHVV, is 0.1%. So also incredibly low. So you wouldn't even notice the difference over the long term. In fact, you would probably notice more. You wouldn't even notice the difference because there are also things that those ETF providers do that improve the index return over time to probably counteract their fees. So there's really no difference. But why do we have both in the portfolio? Well, that was because recently the Australian dollar did touch a very low point in that chart. You would see where it was meaningfully below its average and it was meaningfully at the lower bound of the standard deviations. And it was really just a way to get some comfort around the valuations in the US market as well. You would typically see us hold always a little bit of hedged, I would imagine, in the portfolio, unless we get back to something like parity, in which case we may be going all in US dollars. Some of you may remember, Kev or Mitch, you may remember, I think it was 2013, 2012, when the Australian dollar was above parity. And that's incredibly rare because the average is, depending on your time period, high 60s, low 70s in cents. And so any reasonable range either side of that, we're not too worried about currency. I will add one extra thing is that most of the literature produced around how to use currency in your portfolio, most of the good literature, not like just pseudoscience, it actually comes from a lot of pension funds. And the way these pension funds are designed is that the only thing that they think about when it comes to currency is, can I meet my liabilities? Can I pay out my superannuation payments? Can I pay out my 401ks in the US? And so all of the literature is built around that. It's not built around us trying to predict which way currencies are going to go, because it's one of the hardest markets to predict, in fact. So I hope that helps people. Another hair loss strategy, says Karen. Yes, Karen, chair of our investment committee, is on the call. So yeah, that's another hair loss strategy indeed. So what I would say is just try not to overthink it. It should be negligible.
Excellent. Thanks, Owen. The other one that comes up, and this is more from people taking the high growth strategy or looking at the Jupiter strategy. And I know we have slightly addressed this before on some other webinars, but a question comes up all the time about why do we have bond exposure, and are bonds still relevant in a high growth strategy or in a diversified portfolio at all? I mean, they had just gone through, I think it was the worst year on record for listed for ETF bond ETFs out there. So what place for you guys as a investment team do bonds serve in these portfolios, and why would someone, say in their 30s, investing for the next 20 plus years, hold bonds in a high growth strategy?
Well, yeah, it's a good question. It's a great question because it's been a very active debate in the community as well. I would say that don't look at the last 5 years as being representative for bonds as a whole. The last 5 years, we've seen historically low interest rates counteracted with a massive increase in interest rates in a very short period of time. And so that's not normal. And any time in the past, say 30 years, you would know that that's not a normal trend. And so don't look at the performance of bonds and seeing them fall as an indication of what might happen in the future. Typically, they are more stable than that. Typically, they are positive over time, like the long run is positive for bonds, but bonds actively just provide a counteraction to the movements in shares. And that's pretty straightforward to understand because typically bonds are issued by governments, the bonds that we're talking about, and they're the most, I guess, stable in terms of borrowers. And so typically what we see is a flight to safety in times of economic uncertainty. People put their money into bonds, and that's the role that it plays so that when shares drop, you can then rebalance out of bonds and back into cheaper shares. It also helps people sleep easy at night. Now, in our portfolios, you will see that we have a couple of bond ETFs. We have IAF and VBND for global bonds. So with those two in particular, those two have had a pretty rough few years, but they are the kind of benchmark leaders in terms of bond exposure. For younger people, the Jupiter strategy probably makes the most sense because it only has 10% allocation to defensive assets. Some of that includes cash. In the future, that may even include things like gold as a defensive alternative. It won't pay any income, but you'll still have that defensive characteristic. The other thing that, and maybe Kevin will talk about this in a moment, is there are multiple shades of income. There's not just shares and bonds and cash. Like there are things that sit between all of those things. And one of those things is credit. And so we see some credit ETFs or credit funds on the market. Kevin will talk about one shortly. Graham has asked a good question. He asked one about, will the cat make an appearance? That's Mitchell's cat. But also he asked, is anyone asking for a small exposure to gold? Is that something
To be
that's come
fair,
up?
on the calls, no, gold is not coming up. I can imagine why they might be talking about gold, or why gold might be on some people who's been following closely along, especially with the Rask core portfolios. Because when you jump into the Rask core portfolios, you do see an allocation, a small allocation to gold, but it's not been coming up with new investors looking at the service.
Yeah. So this is actually one of the talking points. That like, when would you allocate to gold? You'd obviously allocate to gold when you would have done it a few years ago. The reason is that interest rates were really low, so your bonds weren't paying you anything. You weren't getting anything on your cash. So what alternative did you have? Some people may remember Tina, not Tina Turner, but Tina, there is no alternative, TINA. This came from the idea that there was no alternative except to invest. There was no alternative except to be exposed to things that you might not otherwise want to be exposed to. And for the last 5 to 10 or maybe even 15 years, gold was that thing that you got exposure to because there was no alternative. If you wanted a defensive position in your portfolio, you simply had to use gold. But with interest rates on bond portfolios yielding 4 to 4.5% and gold yielding 0, it would be very simple mathematics to calculate that you should have less exposure to gold. You can throw in the added, I guess, uncertainty of the currency, as we saw before, being lower. If the currency turns around and you've got US dollar gold, you would likely find that any gains that you make from that gold would quickly go away. Over the long term, it does tend to be better that you put money in unhedged gold position. But if you wanted a hedge gold position, this is one of the things that I wanted to talk about. The only option for investors like us is the QAU ETF from BetaShares. And I'll bring it up just quickly. Sorry, guys, I don't want to digress too much, but see if I can bring this up here into display mode. There we go. This is the only alternative of a physically backed gold bullion ETF. But the management fee on this is probably too high for us to get excited about it. So I think it's 0.59. I'll just see where they've got their, it's probably right in front of me. Fees, 0.59. Yeah, there we go. So it's for us building core portfolios. Many of you will know that the costs of our portfolios, because they are core positions to begin with, are very, very low. And so for us to add something like 0.59 into a core position in your portfolio is too high. So I hope that answers the question around gold.
Owen, before we hand over to Kevin to have a chat about some of the satellite positions he's been researching, which are, of course, sit outside of the core portfolios, this is for someone to and take action upon themselves directly if it suits their needs. Can you talk us about what you're looking? Us through what you're looking at ahead, forward looking for the portfolios. Any changes on the horizons? Are you happy? Are you content with how they're structured and set up at the moment?
Yeah, sure. So what we started with at the outset was a canvas. We had a blank canvas, and this is a very cherished moment in time for any investor and for all of us watching and listening, because what it means is that you don't have any sunk cost bias. You don't look down at your portfolio and see that you've got, oh, Commonwealth Bank, it's done nothing, or I see that, you know, I've got this technology company that I thought was a great idea and now it's horrible. You don't have any of that. So you have an opportunity to start afresh. And what we did is we started with the foundational positions. And you will see some of those expand over time. Anything that I say on the call today obviously has to go before the investment committee. We have to present research notes and so on and so forth. So don't take any of the funds or ETFs that we talk about as recommendations or anything like that. And of course, any of our investors, whether you're in our Rask Core membership or whether you're invested with us in Rask Invest, you get notified when that happens. And obviously, if you're in Rask Invest, it automatically goes through into your account and you can see all that. But you also mentioned at the top of the show, Mitch, that we're getting a lot of interest now. And I think that's because, one, we've just launched, but two, because it's June. And a lot of people watching this or that have come to us are saying, I want this to be my last year of headaches in investing. And I want to start next financial year, as in July coming up, clean. I want it to be the same as what you guys are doing. I want you to do the tax reporting. I want you to do it all. I want to get on with my life. And that's great. So what you can expect from us in the future is we'll probably make a decision in the not too distant future about VAS, the ETF. It's a very big position, particularly in our Jupiter strategy. We may make a decision to break that up and have a different Australian shares exposure. SLT in the RAS community was spot on the money when she identified that we also have the alternative in Australia to use the MVW ETF, which is from Van Eck. That's an equal weight ETF. So we may use something like that. In terms of what Kevin has been researching, we'll pass him in just a sec. We're looking at exploring other ways to get exposure to income between bonds and cash. And that type of thing, or sorry, it's just on the other side of bonds, but basically things like credit ETFs, different sources of floating rates. So this is where you might invest in a fixed income or a bond-like investment, and its payments actually go up or will yield more over time rather than, say, a bond ETF, which yields the same. And so these are the types of things we're looking at. There's sub-D, there's FLOT in that space. There's also the fund. Remember, we can invest in funds as well as individual ETFs and individual shares. So these are just some of the things that we're looking at. We can look at REITs as well. There's so much we can do and expect those changes to follow through probably over the next 3 to 6 months. And if not in the first year of our existence, because the longer we leave it, the more chance there is that capital gains tax will be incurred if we make a change for our portfolios.
Great. Kevin, do you want to, I know you've been busy, one with a newborn, but also with looking at a number of satellite positions. Can you walk us through what you've been focusing on over the last month?
Yeah, absolutely, Mitch. So I sort of power a lot of the global research and satellite positions under Rask Invest and Rask Core. This is probably the area of investing that I love to do. Like I love sort of digging into interesting businesses, high quality businesses, and understanding how they're like really unlocking a whole lot of extra value for the world. So what we're looking for here is basically super high quality stuff that investors hopefully can buy and purchase and then hold for a very long time. So one of the first ones that we've really looked into for Rask Invest is lvmh. Now a lot of people might recognize the brand name and how it's sort of structured, but really important to that is just how old some of the names are in this business. So for anybody that's not familiar, this is a play on luxury goods. So we're talking leather goods, we're talking high-end champagne, we're talking stuff that I can't really afford really, but with that comes really impressive and juicy margins. And one of the things that we love when it comes to high quality businesses is founder led businesses, and this one is founder led. Bernard, I know, is courtesy of running this massive conglomerate has made him sort of the first or second most richest man on earth, and he's done so by basically adding brands to this umbrella of businesses over time. And by doing so, he's not just he's buying businesses, but then also that are already great, and then adding a whole lot of value by being able to eke out more and expand their markets. So him and the family themselves own 48% of the business. They hold 64% of the voting rights, so that's total control of the business. It's a good and bad thing. Like he's got heaps of skin in the game, which is great. But it means that most other shareholders, especially shareholders like us, wouldn't have much of a say. All of his family's involved
His
as well.
family,
So
yeah. I was going to say his daughter runs Tiffany's, I think.
yeah, so
Is that
like
correct?
one of them is like the CEO of Dior, and others are like senior execs, and then there's directors as well. They've got over 6,000 stores globally. The business model is vertically integrated, which means they basically control everything from production to right through to the point of sale. It's been on a really high growth kind of trajectory ever since basically like social media in particular and COVID has taken off. Like there's been so many more people that have had excess income really that they were usually spending on holidays or concerts or whatever, and they're kind of all stuck at home. And then with the rise of e-commerce as well, they've seen huge growth to that. So they've got over 75 iconic brands under the umbrella now. And one thing that you'll notice, unlike some of the other businesses out there that sort of bolt on acquisitions to kind of really juice up their top line revenue, there's a lot of patience that's shown with this business. So, for instance, their Tiffany store, their flagship store in New York, they spent over 500 million redeveloping that. Now, they probably won't see a return on that immediately, but redoing that store has gone a huge way to after their acquisition of Tiffany being able to double their profits within the space of 2 years. Now, this is a business that was already really established, and you think, how can profits be able to grow so quickly under a new ownership? And it's because what they've been able to do is use their immense sort of network and IP and their rebranding skills, and then remarket to younger audiences and new audiences that Tiffany's never seen before. So it's a really interesting business in a few different ways. Throughout the research, one of the cool things that we found was there's a video in the write-up where there's a leathersmith that actually takes apart one of the Louis Vuitton bags. Now, software's really famous for having super high margins, 80% plus gross margins. But in him taking apart that bag, which he spent, $2,700 of his own US dollars on, he estimated that the total cost of the leather, the buckles, the metals and everything was less than 10% of that. So you're talking about a business that's got incredibly high margins, and that they've also got super high pricing power as well. Because with that, if you see on some of the slides, basically they increase the price of these bags every year as well, and that's well in excess of inflation. And they can do that because the power of the brand is just so strong. So it's like, and sort of one of the other things that we found was like, because of that, they really drive on the psychology of their buyers. And because they own so many brands, there's so many different tiers of how the customers come into the umbrella. Basically, if you've got younger customers, they might come in through some of their cosmetics or perfumes, which maybe go through sort of $100 or $500 depending on what they're purchasing, and then they slowly sort of upgrade in terms of like going into potentially beverages or experiences, all the way up to like high-end leather goods and then high-end jewelry. So it's almost like a one-stop shop for capturing all your luxury needs. And yeah, it's pretty incredible to see. And they do this because there's pretty much no discounting on any of the products that you'll see here. So if you go to a shop, normally there's like an end of financial year sale or anything like that. But under the brand, because they value the brand in terms of the sales, there's basically no discounting, and you won't see anything on sale. So, and the reverse of that is actually every year there's also price increases. So every year that the person doesn't buy that bag, they're like thinking, okay, well, if I don't buy it this year for $1,000, next year it's going to be $1,200. And you see that with one of their most popular bags, where like it was around $1,000 US pre-COVID, and that's jumped up to $1,500 US. So that's close to a 50% increase in the short space of a few years. So yeah, an incredible business. The backstory's pretty interesting as well. You'd think that Bernard Arnault was kind of born into this, but he basically was an engineer by trade, and then kind of built up his own family business before sort of jumping into a group of businesses that own Christian Dior, which is one of the most powerful and most recognized fashion brands on earth. And then from that, there was a few other acquisitions that then led to LVMH taking control of that group, and then building that right through. So you can see all the names that have been added throughout his time. And, I think key to this investment thesis is this ability to unlock and add more value over the years. So we think at the minute shares, like, they're definitely not rock bottom cheap, but I would consider them fair or reasonable at the minute. Like, they're trading at 13 times EV to EBITDA, or 25 times earnings, which is close to some of their historical lows, which is around 20 times earnings. So there's not too many comparisons head to head. There's Hermes, which is another sort of handbag or leather goods luxury maker, but they're trading closer to 33 times EBITDA or 53 times earnings. And then you've got lesser ones like Kering, which owns brands like Gucci, but it's sort of much more second tier luxury there. So we think it's a really strong business. We'd love the opportunity to scoop up shares and own shares at a much cheaper price, but I think it's one of the strongest businesses in the world, and it's capturing a lot of value as the world sort of compounds its wealth and gets wealthier as well.
And just for people looking at this who are not invested with this particular stock and the next couple of ones that we're going to talk about, they're not in the Rask they're not in the Rask Invest portfolios. That's content published via Rask Core, and also then onto the Rask Invest side of things. So for people who are running a core and satellite portfolio, they have these investment ideas presented to them that have been vetted by Kevin, and companies, generally speaking, that we're happy to be holders of for the long term. Incredibly high quality businesses. I know, Kevin, you've looked at a couple of more examples closer to home here in Australia. I don't think they both. I've read the headline of one of them, and I know it doesn't fit the bill to the same extent as this one. Can you walk us through the other two companies that you've got that you've taken a look at this month?
Yeah, we might jump into probably the headline that you're talking about, and probably one that's going to be making a lot of news. So that's Guzman and Gomez. So it's definitely my local go-to for Mexican food. Delicious food. Really love the brand. Really love the food. They're, about to IPO. I think the shares will start trading on June 20. So once that goes through, I think the business will be valued at around 2.2 billion. Sadly, there's no general public offer. So unless you're an institutional investor that knows the brokers that are taking this through, or your staff or an existing franchisee, you won't have the opportunity to purchase any shares. They're raising, I think it's around 200 million, and they've got really big plans to fuel their store growth. So for anybody that doesn't know it, they're basically fast food, Mexican food. It's delicious. They do burritos and nachos and drinks and all that kind of stuff. And their store count has really, really grown over the last few years. I think they're ranked 9th now in Australia in terms of store count amongst the brands. They've got 183 in Australia and just over 200 globally. So I think they've got some in Singapore and Japan and a couple in the States as well. So there's been a big push to open these stores that have drive-through sales. They're generating a lot of growth there. The margins on the business, because it's food, is not as high. So we're talking sort of the complete opposite spectrum of things, right? Like you've got software and luxury goods which really command those luxury premiums, right? And then you've got a business which has like a lot of competition, and also there's many more options for diners. So if I'm going out and wanting some quick takeaway, there's Macca's, there's pizza, there's KFC, there's a whole bunch of other stores. So the margins there aren't as impressive, and because of that, like you'll look to a business that, because they're expanding as well, is a lot more capital intensive when compared to some of the other businesses out there. So I think for investors that want to sort of dive into some of the more details out there, like if you look into the prospectus, which you can just Google online or jump onto the Guzman website, I'd probably look at some of the financial data that has that's in that big document. So like some of the things that are probably I guess more warning for me is, and some of the other investors out there, is that this IPO is probably priced pretty spicily. Like it's high even compared to, I guess, some of the peers that are out there. So if you're looking at, I guess, the market leader here, and in terms of a head-to-head comparison, like Chipotle, which has over, I think it's in the States, they're trading for 43 times EV to EBITDA. Whereas if you go towards the Guzman, their FY23 EBITDA, which is what was reported, it's now trading at, like, the IPO will be trading at around 76 times. Compare that to Collins Foods, which owns sort of KFC, that's at 10 times, and Domino's Pizza, which is at 17 times. So that's a pretty big premium in my book. I'd also probably look at, I guess, because they're in such high growth mode, it still looks like there's going to be a fair bit of cash burn there in the business, as well as like on top of the lease payments and the capex to fit out the stores and everything like that. So I know the insiders will still hold a really high chunk, so that's really positive. So that's 62% after the IPO. and they're planning to open 30 to 40 stores every year, all the way up to the next 20 years, and try and hit 1,000 stores. So it's going to be a really interesting growth story to follow. I know Owen did a little bit of reading up on it as well, so I'm not sure if he had any thoughts there.
No, I just wanted to double click on something that you said before, which is that these consumer type businesses don't have the profit margins of software businesses, which is what we typically write about a lot, like technology companies, or even LVMH, as we saw before. But they are wonderful businesses in that they can establish franchises. And I don't mean franchises in the literal sense. Like, they obviously could do franchising, which they do a little bit of. But I actually mean in that a business franchise, it's a consumer-facing business, so they have to have a very strong brand. And I think Guzman ticks a lot of the boxes of a really high-quality business, and a business that has a lot of long-term potential. And people may also see my brief write-up on the company, and mine was more from a behavioural perspective around the euphoria that kind of goes into IPOs. And you touched on this in your write-up, Kev. Is that we don't have the opportunity to take part in this anyway. Like, even if you're sitting out there as an investor with a core and a satellite approach, and you think, I want to allocate, $5,000 to Guzman shares as a small position for me or whatever, you won't be able to do that until the IPO anyway. So you've got to wait. And so I think it's my approach to this is just adopt a wait and see stance and go from there.
Absolutely.
Excellent. And Kevin, so the last stock that you've got for us today, something more income focused and once again listed on the ASX.
Yeah, it's a pretty interesting one for me, actually. So private debt and private sort of financing isn't an area that I guess Aussies have a whole lot of exposure to. I think it's a much bigger market overseas, and but it's one that is developing here in Australia. So I know that there's sophisticated investors and high net worth investors here are really getting a lot of exposure in this area, and that's because the yields here are pretty interesting. So what Qualitas, their real estate income fund is, it's a listed mortgage REIT, basically on the ASX under the ticker QRI. And what they kind of promise is monthly cash distributions, and what they're targeting is the RBA cash rate plus 5 to 6.5%, and that's net of fees. The current fund is and their net asset value is around 650 million. And what they do is basically take investors' funds, and then they invest it in their own Qualitas wholesale real estate income fund investment. And it's kind of like a sub trust that then invests that with direct and indirect loans to property developers, investors, and in Australia, basically in the commercial real estate space. So why, I guess the big question from a lot of investors would be, why would borrowers use something like Qualitas when there's big four banks are giving sort of much lower rates? And the reason for that is basically liquidity, and the supply of capital here in this market is really tight. So in a past life, I was a project and development and acquisitions manager, and like with property developers, the financing side of things is really important, basically because they usually don't have the equity to run these projects themselves. So they would either need to raise this capital themselves, or then go out and borrow money, usually against the asset that they're buying. So as the asset gets developed through planning and then development and then construction, they need financing to do that. And this is where Qualitas comes in. So Qualitas's actual parent is like, I think they manage around $4 billion, and that's grown sort of organically over the last sort of decade and a bit. And it's a space that isn't basically, it isn't as interesting as like a business, but it's more in terms of like the financing, and because what they're doing is they're targeting an area of their market that isn't serviced by the big four banks. Then they're getting the premiums that and the flexibility that they give to borrowers, like that gives them like a decent margin premium on the rates that they can charge. So a couple of things that basically have been really strong in our research is that they've had no impairments to their loan book, and they've had no missed payments. So what that tells us is that they've got a really good due diligence process, and they've got a really good client book where they're backing developers and investors with really good track records. So these are guys that are delivering projects on time. They're making good margins themselves, and they've got the cash flow and the asset base to repay the debt on time as promised. And they split this basically between sort of your first mortgage, and which is secured under assets, and about 80% of that is under a first mortgage. So that's the lower sort of interest rate yield, and then they've got mezzanine finance, which is less security. So that's sort of second ranking finance there, and then that's then split across a whole bunch of different projects. So there's potentially some land only deals, there's some construction loans, there's some first mortgage loans that are under development, and I think it's a really good alternative for investors that are looking to have some exposure in property, get the income side of things, and also have it all under a nice little wrapper with ASX liquidity. So it's something that I hadn't looked into before, but it's a pretty interesting and compelling sort of investment that Qualitas has been doing, and their track record since they have been listed on the ASX is really impressive. Probably a couple of things to, I guess, note is, I guess, the NAV value, which is the net asset value, that's been really stable over time. It's basically been very consistently at $1.60, which is where they price it. And then, of course, the unit price or the share price then fluctuates with the supply and demand of the market. So that's probably one thing to take note of. I guess the other things that we would probably look into a little bit more is in terms of the underlying loans. So they've got 37 loans in total, but they don't really discuss the exactly which projects and that they've made the loans out to. And we'd probably like to look into the amount of, I guess, the residual stock loans, that these are the completed loans, that the completed projects and the completed stock that they're still financing, and how much exposure they have to that. And then I think they've mentioned also some deals with the build to rent models, in particular sort of the Gurner project stuff. So that's stuff that would probably like to dig into more and probably have some more questions answered into there. But there's a monthly distribution. Right now it's yielding around sort of 8 to 9% mark, and that's net of fees. So it's a pretty strong number, I guess, in terms of what sort of income investors are seeking out there.
Yeah. I might just add some things on here real quick. We just had a question from Red Rocket, which was, would Charter Hall Long Whale REIT, CLW is the ticker symbol, be an alternative yield play to QRI? I think what you're getting is you're getting a similar expression, Red Rocket, here, but you're getting a different exposure. So CLW, which is the Real Estate Investment Trust, is investing basically on the equity side. You own the property when you buy the REIT, right? But when you are using something like QRI, you're getting the debt side of the property exposure, which is quite different, because in effect it's like owning the mortgage on someone's property as opposed to the property itself. And that makes it quite interesting and compelling, because you typically see a more stable income return, and you typically see a more stable share price. Typically, not always the case, there's still some movement around. But one of the things that makes this quite unique as well is that the loans are very short duration. So there was a question in here from Peter around property developers turning into a disaster in the 1990s. I was fortunate enough to interview the CEO and founder of Qualitas, Andrew Schwartz, on the Australian Investors podcast quite a few years ago. And these guys have been in the business for decades, and they've been doing it throughout the GFC and these types of things. Like, it's been a very long-standing and established business. And what's really interesting about the business, because of that short duration in the loans. Imagine having a loan for a year or two. There isn't as much execution risk as if you had a 30-year mortgage over that particular asset. And so a lot of these, the people that they're lending them to, they have established relationships with. The bankers know them, have dealt with them many times before. So it's actually quite an interesting proposition for us to potentially add as a slither in the portfolios. But as Kev said, there's still more research work for us to do.
The average
Sorry.
loan duration there, just to add on that, Owen, is less than 1 year. So it's 0.6 years. So we're talking months instead of years here. So they keep a very tight leash on their borrowers, and that's a really good thing if you're a holder of QRI.
Yeah, but that's great. Thanks, Kev. And the other thing to add there is that CLW is actually something that I personally would consider adding to the Rask core portfolios over time, as in to all of our ETF portfolios, even though it's a REIT. We're seeing a lot of volatility in property at the moment. But CLW, which is managed by Charter Hall, is a very well-established REIT. It's a good REIT. It owns some great infrastructure assets, some like property assets, as well as it's got like some other things like service stations and stuff in there. But it is just, it's a real estate investment trust that provides income. One of the things to keep in mind for any folks that know about this is that a lot of the Charter Hall REITs, like CRW, are available in managed funds as well. And the difference is the REIT's bouncing up and down day to day. So you get more volatility in your portfolio. It's going up and down. Whereas the managed funds don't have that as much, but they're not as liquid. So it's not as easy to get in and out. So you've got to just kind of cop it. Like what the price will be when you decide to get out is whatever it will be. But they are interesting because they provide compelling income. And at the moment, a lot of those REITs have been sold off pretty heavily because of interest rates and a few other things. So definitely something that investors can pop on their watch list as well. But yeah, that's a bit of a digression.
No, that was a good digression, Owen, because that was a question that actually came up with a potential investor today. We went around the asset classes. We had cash in the portfolios. We've got bonds. We've got Australian shares. We've got international shares. We've got emerging markets. We don't have any property. Of course, there is some indirect property exposure through something like the ASX 300 REIT ASX 300 ETF that we hold, but no specific standout property as an asset class.
Yeah, and that's because one second, I'll bring up the screen here, and that's because when you look at property as an asset class, it's done this over the last little while, and so you probably don't want to be exposed to that, or if you haven't for the last couple of years, just because interest rates have gone up. That's the simple version, but the reality is there will come a time when you do want exposure to that. And we're just kind of waiting to see how the dust settles across office property in particular. It's pretty scary at the moment. A lot of the tier one warehouse properties and these types of things, the industrial property is absolutely fine. Like with some of trying to find industrial property in Australia is very difficult at the moment. But so you've just got to kind of wait and see. And sometimes with these things, the difference between these things and an ETF is because an ETF, we talked about the construction of an ETF. When you buy, you're basically getting new units created by a market maker. The difference with things like QRI and a REIT is because they have a trust structure that's not built in the same way. Effectively, what's happening is you're buying from another investor. And so from our perspective as investors who are trying to allocate your money, what we have to be aware of as well is that the price could change between now and when a new investor joins in 3 weeks and a new investor joins in 6 months. And so we've got to make sure that those positions that we are buying are really compelling, but two, are likely to stay compelling for a very long time. And that's just, I guess, one of the tricks that we've got to try and pull off. But, all of the things that we've mentioned today for any investor, they should consider popping them on their watch list and doing some more research. Mitch, we did have one question come through Intercom, which was just about dollar cost averaging and that type of thing. Is it okay if I just dive into
Yeah,
something real quick?
please jump into that. I did mention we thank you for reminding me. So I mentioned at the start we'd talk about that, but we haven't yet.
Okay. One of the questions that came through, which was more for the dollar cost averaging, this I've just brought up one of our free courses on Rask education. So anyone can go and take this course. It's just our free like money course and budgeting course. It's on Rask. I built it years ago, years and years and years ago. But what I wanted to do as a person that kind of started with investing and then figured out the personal finance stuff later on was I wanted to create a system that allowed me to automate my money. And a lot of the people in our Rask Invest service will be doing this over time. They're still working and like us and wanting to add money regularly. And most of us also have superannuation. So that would be an aside to this. Like superannuation is off to the side. That's already happening. It's about 10%. But imagine your income comes into your jar. Well, you've got expenses and everything and holidays like going to Florence if you're lucky enough, things that you want to do. But then we have this is very similar to the barefoot budget as well, if you follow that, which is that I have always advocated for about 20% of your savings to go towards investing or for the long-term you. And so this would be things like paying off debts if you have some credit cards and that type of stuff that you need to get rid of. If you've done that, it's getting that emergency fund in cash. If you're in retirement or if you're approaching retirement, this one says 3 to 6 months of cash. I would have more than that if I was in retirement. I would have 1 to 2 years worth of living expenses in cash. And then finally, once that's done, once you've got your emergency fund, once you've cleaned up your debts, is then use that money for long-term investing. And so one of the questions that we often get is, well, I get paid, every month. How should I be allocating that? We can't give personalized advice, but what we can say is this is the model that I've advocated for a very long time. There are others that do the same. And the question then becomes also, does market timing make a difference? Like if you've got a lump sum versus income, does it make a difference? What I've ultimately concluded is that if you have a diversified portfolio across all different asset classes, it shouldn't matter if you make a lump sum investment because you're investing in a diversified portfolio. That should be all weather. But from a behavioral finance perspective, most people can't invest $1 million of all of their money in one thing at one time. So what we advocate for in that instance is the behavioral finance element is break it up. Take your time. Do what makes you feel comfortable. A lot of our investors, Mitch, and correct me if I'm wrong, have decided to invest 20, 50, 100, maybe even more, 150, 200, whatever the case may be, to get started and then continue to add more in. We've had a lot of people come through and want to do big in specie transfers, like where they transfer their shares in. But the reality is this chart here shows you does market timing work. And this is from Schwab, and they update it, I think, every year for the latest data. But basically what they did is they run simulations for the S&P 500 in the US. They give 5 people $2,000 on the 1st of January every year. Peter, Ashley, Matthew, Rosie, and Larry. And basically, Peter has perfect timing. Another one invests on the first day of every month, so they break it up. That's dollar cost averaging. Another one invests immediately on the first of every year, as in when they get the money. And another one has the worst timing. So this is Rosie down here. Rosie takes her $2,000 and happens to pick the very top of the market every single year and then stay invested. And finally, we have Larry, who was left in cash. And as you can see from this chart, and we've recreated this with a bit of Rask flair from time to time, what you can see from this chart is the first 3, so perfect timing, investing on the 1st of January, and dollar cost averaging. The difference between them is not that significant. The difference between having perfect 2020 vision on what the market will do versus just dollar cost averaging versus just investing it when you get it, over the long run, it all smooths out. It all kind of goes to the same. It all regresses to the mean. And so with us, it just makes sense to stay invested and to keep investing. And that's the hardest part, is the staying invested. But we've got heaps of literature on how to automate your money, how to invest regularly, why it makes sense, so on and so forth. But a core portfolio is by far the best way to do that. It's build a core and a satellite if you're interested, like Kevin and I would do, and I believe Mitch would do, is you can have, the lion's share of your money invested in a core low-cost portfolio, and then express yourself, have individual positions as you learn, or if you're interested and you're curious, develop that side of your investing skill set as well.
Yeah, and that's what we're seeing, Owen, come through with the people that are actually investing in Rask Invest. As I said at the top, they're people who are curious. They're smart individuals. They're curious. They want to be handpicking perhaps a specific ETF themselves, or handpicking a couple of individual stocks that they're really interested in, or even following along with some of Kev's research that we are publishing. But they know for the bulk of their investing, they want something that's going to do what it says it does on the tin, and that is the Rask Invest core portfolios there. Fellas, I'll open it up unless have you got anything else you'd like to add before we look to wrap today's session up?
No. Maybe one extra thing is, Kev, I was absolutely blown away when you said that Tiffany or lvmh spent $500 million on their store. I don't know if anyone else caught that, but let's just think about that for a moment.
I don't know how you spend $500 million on a store fit out.
It's actually even, there's one in Paris, which I think they spent €1 billion on, and it's taken them, I think, over 10 or 20 years to restore that completely. So there's not many businesses that can kind of withstand that kind of CapEx spend, but it shows the type of view and the type of time frame that these guys are looking at. And I guess in that sort of luxury world, it's a different type of game.
One of the things that's really stood out to me being here, particularly in Florence, is that like the time horizon that people deal with. Like the Basilica here in town took 16 years just for them to build the dome on top. In fact, the guy who designed it, the engineer, he died before it finished. And that is still here, hundreds of years later. And I think a lot of what we do as investors is similar to that, right? Like taking that long-term perspective. I think with AI and faster trading algorithms and these types of things, what we have left as investors is building things that stand the test of time and using that time to our advantage, because no one else seems to be doing that. Everyone else seems to be shortening their time horizon and their attention span. And one of the best advantages I believe anyone could have is actually just go, you know what, we're going to lengthen that time horizon as much as possible. And we've started to see that shake out in most of the investing community, which has been lovely.
Awesome. Guys, thanks for taking the time to join us, especially you, Owen, on your taking time out of your holiday.
Always.
Everyone live, thank you for joining us. Thank you for sending in your questions. I'll just pop my little link up again if anyone did wish to book in a chat with myself about the portfolios or anything that we're doing here at the Rask Group. But guys, thanks for your time. Everyone, thank you for joining us, and we'll call it a day. Cheers.
Thanks, everyone.
Wonderful. Thanks for joining.